think of that balance with the other objectives that you have for the investor. We think of some of the things that we've talked about in pursuit of that intersection of yield and quality, also bring with it the benefits of avoiding potential missteps, commonly associated shortcomings, whether it's concentrations at the sector level or the security level, and those types of things, again, are mitigated by having the right approach. And with that, I would like to turn it back to Ali, and we'd welcome questions from the team in the audience.
Thank you very much, Chandran. Thank you for leaving us with plenty of time for questions. Let's start with a question that's been coming in from a number of audience members. Is this overdone, this whole dividend thing? It is all the rage. I can tell you as a journalist, there's probably several dividend funds that seems to launch every month, and everyone's talking about it. This quest for yield is very real. Is it overdone? Do you feel this claim is true?
Well, I'll let Chris lead off, and I probably will have some things to add. But Chris?
Yeah, sure. You know, and I think that what we're seeing, you know, is obviously sponsors and providers really meeting the demand that we're seeing from investors. You know, as far as, you know, to kind of turn that a little bit, you know, I think there's a lot of media out there that, you know, claims that the dividend yield stocks are overvalued, and really we don't see that. Dividend payers still, you know, in our opinion, have room to grow via research. You know, if you look at the S&P 500, dividend payers are trading at lower PE multiples than non-dividend payers in 9 out of the 10 GIC sectors. You know, and where you're seeing the only sectors where dividend payers are trading at higher PEs than the S&P 500 as a whole are consumer staples, financials, and until the recent sell-off we saw yesterday, utilities. And really, that's part of why we want to talk about the being cognizant of those growth sector overweights, because the sector areas where they're most frothy tend to be the areas that are most defensive, where people have traditionally gone to get that yield. So by focusing on the areas by looking at the total market and not just focusing on a few sectors, it tends to be what we're seeing as a more prudent play as we move forward in the volatile environment.
And Ali, I would just add this. You know, the way that we come at it is always taking a long-term approach. And so, one, we look at the need to generate income on behalf of the end investors as a fundamental need. And arguably, with some of the demographic trends that we see, that need only grows as we look out over the next 10 to 15 years. And so it stands to reason that this would be one of the areas of the marketplace or the tools that one would use. I would also just mention for context, if you think about just how we look at returns on investments, and you look at the long-term historical returns of equities, a significant portion of the return that we receive on equities over time actually comes through the dividend. And so I think that's something that sometimes we lose sight of and we get away from. So for those more long-term and strategic reasons, we wouldn't view it as overdone. It doesn't mean that you might not have at times a proliferation of products, but I think that's a different issue as to whether the focus on that potential fundamental need is overdone.
Thank you very much. Let's take a step back. Obviously, we're talking about an extraordinary environment with super low rates. Central banks around the world, as you guys say, are all jumping in and creating this financial repression. One question that came in, as a matter of fact, a couple of them. You know, you don't have a crystal ball, but when do you think this is all going to start running its course? That these super low Treasury yields are going to start reverting to some kind of historical mean?
Yeah, so I would offer this if I were to say, you know, from an overall asset management standpoint, how we think about this and how we're helping investors position their portfolios agnostic to a particular type of product, ETF or otherwise. We have held the view for some time that rates will be lower for longer. Certainly you have a most recent period where you've had an uptick in rates, but there are so many things that we see about the structure of financial markets, the condition that various, especially developed countries, find themselves in, that speak to why we hold this view. So in our minds, it is a less likely occurrence, although maybe more people are moving to that say over the next 6 to 12 months that we see a significant shot up in interest rates. As a matter of fact, it would be more likely or a higher probability to us to see this low interest rate environment persist throughout not only the next 12, but maybe even as far as the next 24 months.
Got it. Okay. So then let's turn our attention to some of the other questions that are coming in here. And not to steal your thunder, but there are certainly other alternative vectors to generate yield. You guys make a good case that this is a requirement. You can't get around it. Investors need this, especially those in retirement. What about, let's say, the senior loan market? There are a few funds out there. Clearly, it serves that need. Is that an area that you take seriously enough to consider product development there?
Yeah, I would offer this, and Chris can add. So I think that you have to look at it in two different ways, right? One is the asset class attractive, but then it's a secondary question of how do you get access to it, and is the vehicle most appropriate? So I would say to you, there is a strong empirical case that can be made for senior debt, actually particularly of privately held companies, because if you look historically, not only have they had low relative default rates versus, say, large established companies, but there's the changes in the structure and the regulatory environment have actually made it harder for those types of companies to access capital, and even though they might have strong business models and strong balance sheets. So if you were looking to, say, invest directly in that part of the market, say senior debt, particularly with quality privately held companies, you can make an attractive case for that. Different question as to whether or not the best way to access that is through an ETF, and I know people have increasingly looked at ETFs as a mode of access to different markets. The caution that I would give there is access does not translate to liquidity. And so, again, for an ETF, ultimately the liquidity is driven by the liquidity of the underlying. So you don't necessarily, while you can enhance the accessibility and maybe on the margin do some things with respect to liquidity, it's still important to understand what the underlying liquidity of those markets are and if a structure like an ETF is the best way to access that.
Got it. Now let's circle back to dividends, since you obviously have quite a lot of products, and as I said at the beginning, you've parsed the space quite extensively, both domestically and internationally. Very granular question that came in, and a good one. Do you incorporate share buybacks in your dividend and quality evaluation of your holdings?
Our model is proprietary per se, but when it comes to share buybacks, really that would be something that we look at in management efficiency. So when we talk about the use of external financing, we view share buybacks would be something similar to what we would consider in that sleeve as far as how they deploy capital. Are they increasing, decreasing shares outstanding? Are they increasing, decreasing debt issuance? So that would be something that we would consider as something that would be almost like a management signal.
Okay, thank you. Now, as far as the parsing that I referred to a moment ago, you've got 6 funds out there. Part of me is thinking, is this too much of a good thing? Obviously, the quality and the yield combination that you guys spoke about extensively, that seems compelling. It seems like a good idea, a good pairing. You guys made a persuasive case, but 6 ETFs, are you confusing the issue? Why not do like a mother fund that concentrates on quality and yield, and make your sales and marketing efforts easier to minimize any potential confusion for investors who are really warming up to this space and its importance?
So actually, that's a great question, Ali, and it's something that we think about very intensely. So when we're thinking about how to best deliver a strategy, and Chris may add some thoughts to this. We start and we get engaged in an iterative process thinking about what the needs of investors are. We also try and think of what kind of things are we trying to deliver. So we talked a lot about the intersection between yield and quality. What we didn't talk about a lot, and I think is an important component of what we're doing, Ali, is we look at this as the opportunity also to provide, say, a broad-based exposure to the equity market, right? And so think of it as you could have, in a sense, a portfolio built around a core of high-quality stocks that would form your equity exposure, but would also give you the ability to enhance the generating income of that portfolio. And with that in mind, that's the stepping off point for where we move to thinking about how do we have, say, the three funds on the domestic side. Because what we start with is a core strategy that says we're going to give you something that's going to more approximate the sort of beta that you would expect in the overall market. But we also understand and appreciate from dealing intimately with investors is there may be, in addition to kind of your bottoms-up view, a top-down view that says we have a view in terms of what we're thinking about in terms of the valuations in the market, the volatility, and say we want to enhance that, or we want to have some beta above and beyond what that is represented in the market. Or the reverse. You may want to have somewhat of a more lower volatility type approach. And so basically the suite of three, whether it's on the domestic side or the international side, give you the ability to do that. So what we're doing there is not certainly not looking for proliferation of product. You know very much about our approach. If anything, we would rather fewer strategies or products than more. But this is about giving investors the tools that they need to really not only deliver what we say in terms of that primary need of generating income, but to very specifically be able to target and manage the risk in a portfolio. And so that would be what I would offer. I don't know if Chris would add to that.
No, I agree. You know, when we were looking at these products, and, you know, really, as Chandran pointed out, you know, we talked about wanting to have market exposure and talk about how we could target high yield, high quality, and market exposure. But as you talk to investors, you know, some people prefer dividend products to have that defensive tilt towards it. Others say, you know, listen, I buy into the quality and yield stories. I view these as alpha drivers, and I want to be as aggressive as I can with these factors. And I look at this more not as an income generating tool, but as an active kind of product, you know, to take those alpha drivers. And so I want to be more aggressive with that. So really, what's really cool is that we're able to give the same level of quality and yield across the board in all three products. So that's kind of the thing that's really interesting, that by going defensive or going dynamic or being in the base case, you don't have to sacrifice your yield. You don't have to sacrifice and get into lesser quality or higher quality. And you don't have, you know, and each of these products are one of the things I'd like to point out is distinct as far as the holdings. Now, if a stock is high quality and high yield, it'll be in all three products. But sometimes a stock that has a little bit lesser yield but is still high quality but has a higher beta might make it into the dynamic product that we won't hold in a defensive product. So really, it's a really unique way of looking at all three products, and it's giving investors you know, different choices along the lines of what we think that they're looking for.
Well, I'm glad you talked about some of the different sectors. This concept of quality is not unique. I don't mean to get in your face, but how does your approach differ from other strategies? And as long as you're talking about specific sectors, as you differentiate your product from others, are there any sectors that just don't make the cut in any of these 6 portfolios we've been talking about today?
So I'll take the second part first. As far as the sectors go, we judge quality on a sector basis, and when we get to the international product, we also look on a regional basis as well, because obviously different regions and different sectors have different levels of cash flow, different levels of profitability, depending on how mature the markets are. And we view quality as something that's not just specific to one industry or one place. That you can find quality companies in every industry, every sector. And we're not avoiding any sectors. In fact, if you were to look at where the weightings line up, they're fairly close to what the broad market has in their products. And the reason why is because we don't want to take those bets. We're not betting for Japan, we're not betting against Japan, we're not betting on Australia, we're not betting on utilities or technology. We want to keep those exposures in line as much as possible. So this is a tool that fits well into an investor's portfolio, that they don't have to adjust things around it simply to hold this product. That they now are overweight certain sectors because they bought the specific product. And also the other thing would be with that is that, we want to take as little tracking error and court as much non-compensated risk as possible by having sector overweights or underweights, because that's truly what you're doing when you get those large over and underweights.
Got it. Now, I wanted to touch on some of the, let's call it the dangers of dividend investment. It would appear that as important as it is to generate yield, especially for the cohort that is retiring, some people may not have the stomach for a market swoon, watching their capital just kind of shrink all of a sudden, even if the dividend remains relatively stable in a sell-off environment. So, can you speak to that? Are there instances? How do you respond to an advisor or an investor who says, I can't bite the bullet. I realize it might be necessary, but I can't do it. What then?
Right. I think that's a great question, because what it allows for us to do is to have, an important level of dialogue, because sometimes you really have to parse, Ali, what really is the objective. So the first question you would have, if that's the disposition, the question is, what really is the objective? So is the objective truly all about generating income, or is the objective about preservation of capital? We should be clear. Those are actually two different things. And it doesn't mean that there can't be some intersection of them, but I think that's important. And I think that's a healthy dialogue to have, because depending on the nature of how that conversation goes, it allows you to do that. Sometimes what you may find ultimately is that while there might be competing objectives, that one more outweighs the other. And so if yes, I want to have an attractive income, but I'm really concerned as a principal focus of preserving the capital, and then arguably in any scenario, even if you have a relatively conservative equity investment, it might not be the right thing. But I want to be clear, that doesn't mean that the strategy wasn't effective, or it wasn't the right investment, or it was too risky. It just may mean that there was a mismatch between the true nature of the investment objective and what the product delivers. Conversely, sometimes what we find in those dialogues is, while there might be some discomfort there, as you're able to work through it, there is more comfort that is gained. Because the reality is, while certainly you could say with certain fixed income securities, there's a lot of preservation of principle. Let's use, for example, Ali, an asset class that's valuable, but let's be clear, high yield has a high correlation to equity securities. So if we're talking about the difference between, investing in a high-quality dividend-paying stock versus, say, investing in a high-yield security, how much difference are we talking about? Or is the investor really avoiding the potential risk of the demonization of the corpus that they believe they are? So I think that's how we would think about it, and I think it's an important question, and we work with investors and their advisors on that all the time.
So, okay, let's say you're having this conversation. It goes well. You make your case. They say, okay, you've allayed enough of my discomfort to make me open to this. So hold my hand here. I mean, I'm asking this question on behalf of some of our audience members who probably have clients who are baby boomers who are entering retirement. How much is appropriate here? It's probably a very personal question in terms of risk appetite, but give us a range. I mean, you're not going to go all in with dividend stocks as opposed to treasuries all of a sudden, but you're going to do more than dip your toes as well, I presume, right?
Well, again, I would offer this as an opening salvo, and Chris can add to it. The first thing, and what we always encourage, and I would tell you, Ali, sometimes we find that it's not done enough. You have to think about it in the context of your overall portfolio. So what do I mean by that? Say, for instance, in an overall portfolio, you have some allocation. I'm going to make this up for the time being. We're looking at a traditional sort of foundation and endowment type allocation where you got like a 60-40 breakdown. One of the things that you might find is in that core equity exposure that you don't necessarily have attractive income-generating equity portfolio. And so what I mean by that is we may be able to, while keeping the overall risk of the portfolio pretty consistent, just say move core exposure to one sort of core equity product to a product like this that still gives you, like Chris was speaking of, exposure to the growth-seeking components of equity, but we've enhanced the income generation of that equity portfolio. So I could start in a place, Ali, that says, I haven't even changed your fixed income portfolio, but by maybe changing your equity exposure, I've enhanced the income generation capability of your portfolio. So first of all, it's not just about displacing fixed income. I think the next thing that we would look at is if we were talking about fixed income, you'd have to dig down into that and say, of your fixed income allocation, how is that allocation set up? If your allocation is predominantly, say, to Treasury securities, right, that's not going to necessarily be, obviously, that's not necessarily, it's not going to be an even exchange for something like a dividend-yielding stock. So by definition, you're going to have a different risk profile if you were substituting that for that. It would be more likely that we would look to the places where you're getting income that might have a more comparable risk profile, and we would and you would kind of look to say, is that really efficient? If it's efficient, maybe you leave it there. But if maybe on a comparable basis, we think there are some efficiencies for substituting what you might have and some higher risk profile types of fixed income investments. Examples could be things like emerging or sovereign debt or high yield. Those would be components where you might be able to shift the portfolio. And again, we're doing that while at the same time maintaining a more modest shift in the overall risk exposure of the portfolio. If that makes sense, that's how we think about it. So actually at the end of the day, it doesn't really wind up being this wholesale skew of your portfolio moving significant amounts of fixed income into equities necessarily, depending on what you have in your portfolio.
Got it. Now, let's talk a little bit about you sort of floated a 24-month window at the least in terms of when the Federal Reserve might begin to normalize its monetary policy. No one knows, but talk to us a little bit about the risks involved in dividend-focused equities as it relates to a normalization of rates. We all know about fixed income. You don't want to be too far out on the curve. You know, if you're really conservative, you just stick to T-bills and short-dated T-notes. But what's it like for a dividend-type strategy that is, in part at least, the yield-generating piece of a portfolio?
Yeah, I'll let Chris speak to that.
Thanks. You know, generally we're agnostic. I'm sure you're touching on the thought process of the Fed tapering their QE programs, right?
Yes, absolutely.
Yeah. So, you know, actually we're generally agnostic to the Fed tapering, but really, if you think about it, any tapering would be contingent on positive economic data. So, and really, tapering is not synonymous with tightening, so we're not going to see, it's a very unlikely scenario that the Fed would let the long end of the curve rise dramatically swiftly. You know, and so, you know, to steal an analogy Bob Brown used is, you know, if you're standing in the bottom of a 10-foot pool of water and the Fed lowered it from 10 feet to 9 feet, you're still you're still underwater. And it's just as likely that they'll move. This is just a tool in their repertoire. And if they move to 9 feet, it's just as likely that they'll move back to 10 feet as it is to move to 8 feet. I think the one thing that we should take away from this is, regardless of your view, there's a lot of contention in the investment community is what is actually going to happen. And it's because of this, this is another reason why you want to concentrate on quality when you target dividend in the equity market as well.
Okay. The other thing I would just note is that at the end of the day, one of the big risks that you're concerned about with respect to the interest rates Some of it has to do with credit, but a lot of it has to do with duration risk. And to that, if that is in fact the risk that we're focused on, that interest rate sensitivity, you don't have even remotely the level of interest rate sensitivity with dividend-paying stocks that you're going to have with some of the fixed income alternatives that we're talking about. So arguably, all other things being equal, when you weigh it all together, you could argue that some ownership on the margin of this versus those things, if your true concern is interest rate sensitivity or duration risk, you'd be mitigating some of that risk by having exposure on the margin here.
Yeah, and I'll just follow up on what Chandra just said. You know, there's a Boston Consulting survey, that the research paper that they did, that points out that boards, when they set dividend policy, are cognizant of interest rates as well as taxes on portfolios. So they tend to take that information when they set into context when they do their dividend policy. So as opposed to a fixed coupon payment product, dividends have some elasticity in that.
Got it. I think we have time for one more question. If you encounter a client who really can't do it, can't go out on the yield curve, can't do high yield, can't do emerging markets, can't even do dividend stocks, what about a security like your Ravi, the very short-dated fixed income? Is that a viable way for someone to play it really safe and maybe eke out a couple of extra basis points so they're not too far underwater after inflation, or is that more of an equitization of cash kind of approach? Can you speak to that product? Because it seems germane to this in terms of this rate environment that is so worrying.
Yeah. So I would say quickly, we're hopelessly biased, but the principal value of Ravi, we think about it in terms of managing liquidity in a portfolio. But secondarily, if you're thinking about how you would say be investing your strategic cash, certainly given the structural changes that have went on in the whole cash or money fund environment, we think this is a tool that people would look to be on the margin able to enhance the yield in that part of the portfolio. So the short answer is absolutely.
Okay, great. Well, that is about all the time we have this afternoon, and I want to thank you, Chandran, and thank you, Chris, as well. I want to say that on that note, on behalf of all my colleagues at IndexUniverse and FlexShares, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.
Thanks.
Thank you.